When you are estimating a growth rate on a company, of a very predictable company, I imagine you apply a big margin of safety to it. What kind of rate do you generally apply? I mean, high single digits?
In the margin of safety, or
what kind of growth rate would you, on a predictable company, might you
we are willing to buy
stab at?
companies that aren't going to grow at all.
Okay.
Assuming we get enough for our money when we do it. So we are not looking. We are looking at projecting numbers out as to what kind of cash we think we'll get back over time. But would you rather have a savings? If you're going to put $1 million in a savings account, would you rather have something that paid you 10% a year and never changed, or would you rather have something that paid you 2% a year and increased to 10% a year? Well, you can work out the math to answer those questions, but you can certainly have a situation where there's absolutely no growth in the business, and it's a much better investment than some company that's going to grow at very substantial rates, particularly if they're going to need capital in order to grow. There's a huge difference in the business that grows and requires a lot of capital to do so, and the business that grows and doesn't require capital. And I would say that generally financial analysts do not give adequate weight to the difference in those. In fact, it's amazing how little attention is paid to that. Believe me, if you're investing, you should pay a lot of attention to it. Charlie?
I agree with that, but it's fairly simple, but it's not so simple. It can all be explained in one sentence.
Some of our best businesses that we own outright don't grow, but they throw off lots of money which we can use to buy something else, and therefore our capital is growing without physical growth being in the business. And we are much better off being in that kind of a situation than being in some business that itself is growing, but it takes up all the money in order to grow and doesn't produce that high returns as we go along. A lot of managements don't understand that very well, actually.
So here's the math behind Buffett's question that he posed back at the individual, asking for what growth rate Buffett applies to a quote-unquote predictable investment. And Buffett was clearly sort of irked because he knew that this individual was just looking for some sort of formula, some sort of blind growth factor to apply. But when we look at the math here, we can see even on a nominal basis, the account that gives you 10% a year is still going to be ahead in terms of earnings, not even to mention cumulative earnings, until about year 18, and we can see that on this first graph here. What's really interesting is on a present value basis, which is how you should look at cash flows. You're discounting them back. The account that starts off at 10%, this quote-unquote boring company that does not grow, if we look at this chart over here, it stays ahead well over 50 years. So you would, from a rational standpoint, you would never choose this growth company. But people, investors, analysts, they do sort of have this feeling that growth is always good, but that's not necessarily the case. And you can even quibble at the numbers here that I've put in, but say this investment, instead of giving you 2% a year, gives you 5%. It's still until about year 19 or 20 that the present value of that second growing stream of cash flows exceeds the quote unquote no growth series of cash flows. And so to me, that still means you should choose that certain cash flow because you're getting it today. A lot of things can happen in 20 years. A lot of companies can't grow 10% a year for 20 years, 2 decades. You can even play around here with the discount rate. You say, well, maybe that's what's happening here. Let's go to 7.5%. It's still year 17. Even 5%, you're still looking at year, well over year 15. So what really matters, my study of Berkshire Hathaway, what I saw time and time again, is that Buffett really prefers the cash up front. The business doesn't necessarily have to pay it all out, but it has to be generating earnings that could be paid out in cash very close to the present day, if not that first year. So even at 6% paid out at the beginning, you're still looking at, on a cumulative present value basis, right around year 11. So over a decade. So what this really tells me is a couple things. And I'll put on the screen, I did a Twitter poll. It's not finished yet, but I've had over 250, about 250 people respond to this poll saying, which would you choose? And I was actually leaning towards the scenario 2 at first until I looked at the math and said, wow, this is really compelling to have this seemingly higher level of growth, 10% a year compared to the first option. Intuitively, I wanted to choose that one. But when you look at the model, you say, well, geez, this is pretty clear. And so this has all kinds of implications in terms of today's investors looking at higher growth companies. Most companies, as Buffett says, have a capital requirement. If you look at a business, most businesses have some sort of linear relationship between whether it's plant, property, and equipment that's relatively flat compared to revenues, working capital to revenues. Most businesses require some sort of capital investment. And so I hope this illustrates the fact that growth is not always good. It can be very good. Please check out my other video on growth where I actually link to the spreadsheet that I created with a discounted, basic discounted cash flow model. So again, thanks for watching. Please subscribe, like the channel. If I've messed anything up here, please let me know. I'll go ahead and reset this here. But thanks for watching. Please subscribe, like the channel, all that stuff that everybody else on YouTube asks you to do. Please do those things. Hit the bell, smash the bell, whatever they are asking you to do. But thanks for watching. And if anybody's interested in the spreadsheet, let me know and I'll post a link to that. So until next time, stay rational.